I'm Justin Klein, and I'm excited for this hour with you today and to help you accomplish your goals. And that takes incremental steps. You rarely take giant leaps. It's about putting one foot in front of the other and making every day count. Now, in today's changing market, it's important to have a broader perspective. A long-term perspective, looking multiple, not just a couple of decades. 10 years seems like a long time, but in market history, it is not. Because there are cyclical cycles and then there's secular cycles. And we are at the end of one. And that is the cycle that really, or the secular cycle that was brought on by combining Western capital with Eastern resources. And this is post the fall of the Berlin Wall. Even started a little bit before that with Japan and their growth throughout the 80s. And that was really the kickstart of exporting manufacturing jobs, et cetera, and having this free flowing of goods throughout the world. And it was lit on fire when we had the fall of the Berlin Wall and you had all of the when I say Eastern resources, not just the commodities. Think of the commodities that came out of Russia post the fall of the Soviet Union, but also the labor within Russia as well as mainly China. And so you combine that with Western capital and know-how and business expertise, and that brought this immaculate disinflationary world. And now we are at the end of that. That is all reversing to some degree. In fits and starts, but we know that trend has shifted. So that's what we are here to help you navigate, and I'm going to do that by answering your questions and giving you my unbiased perspective developed with over 20 years of investment experience. So we're going to talk about today's market performance and run down some show topics, but right after we answer this first caller question.
Hi, Justin or Steve. Wanted to get your opinion on ticker symbol J, Jacobs Engineering. I'm still up about 20%. I've owned them for a couple of years now. Just wanted to get your thoughts on the company. If you think I should buy more, hold, or sell a little bit. Thank you. Bye.
All right, looking at Jacobs Engineering, and this is in the heavy construction industry. It provides technical, professional construction services to industrial, commercial, and government clients. Pretty large, $16 billion company. And let's go look at the balance sheet. The balance sheet in today's world is probably the most important aspect that you have to analyze of a business. And for them, they have roughly about $3 billion in debt on free cash flow of nearly $1 billion. So very, very strong balance sheet. Nothing wrong on that front. Not a big dividend payer, but like I said, this is an environment where you probably don't want a lot of big dividend payers. You want the low dividend payers with good balance sheets that can grow that dividend over time. Much better place to be invested. Now, Jacobs is also buying back shares. They had 130 million shares outstanding back in 2021. And actually, let's zoom back out. They're a consistent buyer of their own shares. 2018, 142 million shares, now back down to 126 million shares. So I like that they are using a lot of that free cash flow to buy back shares at looks like reasonable prices. Now the chart has pulled back as of late, was at 140 and change. Now it's about 133 and change. Still is in an uptrend. Clear uptrend, absolutely outperforming the market since it peaked in mid-July. In fact, this is still up since mid-July. So these are the type of names that you certainly want to own. Return on equity right around 12%, which is not amazing, but it's solid and it's a consistent performer. That's what I like about it. If you go look at the earnings projections going back all the way to 2016, they pretty much made more and more money every single year, even through the pandemic. So even a pandemic can't really shake their business. So I like this. I would hold on to it. I see no reason why you'd want to sell it. It's a pullback. It's a natural way these things go. All right. Now we have a lot of ground to cover over the next 45 minutes. Here is what I have planned, time permitting. Now, my main focus point looks in the story set up by this headline: Lessons from the Post-Pandemic Bull Market. And we know the Federal Reserve is powerful, but they are clumsy. They make mistakes. So we're going to look back on this last 3-4 years and see what we've learned. So we're going to talk about the post-pandemic bull market, post-pandemic investment options that you might have picked or maybe avoided smartly. And it'll give us a lot of insight into investor behavior. Now, on top of that, we also are going to touch on a few other things. When interest rates go up, that breaks things. We've had this is a story as old as time. So we're going to look back in history and show you what broke in the past. And hint, it almost rarely is the last thing that broke. Think the housing market. Rarely as ever. Also, the set and forget it portfolio. Is that going the thing of the dodo bird? We're going to look at that. And then also the type of companies that have outperformed since June, the end of June, which is really kind of around the peak of the market and when interest rates really started to head higher. And it'll tell you a lot about the type of companies that will thrive in this type of market. All right, we have a lot of voice bank questions to get to. One is on Texas Instruments as well as Google. And I'll try to fit in an iTunes review question as well. Let's talk about the market overall today. It was certainly a down day on the back of Meta's disappointing results. That was down about 3.7%. But it weighed on the big large cap tech in general. Tesla was down 3%. Apple was down 2.5%. Amazon down an additional 1.5%. I believe. Did they report results? I know it's either after the bell today or was it tomorrow? Let me pull this up. Oh yeah, it's moved pretty decently. Yeah, I think they're up a little bit after hours. Nothing crazy, but overall, the large cap growth is down 1.77%. But there were swaths of the market, parts of the market that were actually up. Small caps are up about 0.3%. Small cap value up 0.83%, almost a 1% positive day on the small cap value front. Mid cap value up 0.36%. So a big difference between large cap growth down 1.77 and small cap value up 0.83%, about 2.5% spread in just this one day. Big move in growth versus value on the day today. Nvidia down 3.5%, threatening to break some major support, and you could see that flush lower. Obviously, that has earnings coming up as well. So interesting day, but really the main story today was that drastic outperformance, the biggest outperformance of value over growth since July 20th. And that kind of sparked, I think, the shift in the market. And you're starting to get that follow through. So while I think we have a positive year end, right? S&P higher than where it is today. I think this is the start of that rotation and getting shades of 2022 again, where you have those large cap techs really taking on the chin on higher interest rates. And, the Meta news was, or the earnings were not that bad. But when you have, actually, I would say the earnings were pretty good. And the market, and it was down. So when you have good news and prices are down, that is a sign that things are too stretched. It's over-owned, and there's more sellers out there waiting to sell than buyers waiting to get in. And that's what you're seeing in a lot of those large cap tech names. And many are very over-owned by the hedge funds, which we call them hedge fund hotels. I mean, they're in when the trend's good, but they're quick to get out when the trends have shifted. And for many of those large cap tech names, it looks like this earnings season has broken that uptrend. All right, we're heading to a break. Let me tell you about the new InvestTalk Sector Spotlight series that you can find for free over on YouTube, and it's focused on the real estate sector. And we know that this is an environment that's different than 2008. Not a lot of forced selling. Many people locked in to fixed mortgage rates at 3%. And so that creates tight supply. Almost no matter what, because we've had a decade plus of underbuilding. So if you want to learn more about this cycle, how it compares to previous ones, head over to our YouTube channel and check out the InvestTalk Sector Spotlight on our real estate episode. All right, phone lines are open, waiting for your questions at 888-99-CHART.
Get ready for the next InvestTalk Wealth Webinar. Profit amidst chaos. Strategic investing in a recession. The Wealth Webinar will be presented online and free of charge, but you have to register in advance to reserve your spot. Which sectors tend to soar and which plummet during economic downturns? With the right strategies, you can safeguard your investments and also seize unique opportunities. So join InvestTalk hosts Justin Klein and Luke Guerrero of KPP Financial as they take you through the maze of mysteries involved with investing in times of recession. Tell your friends about the next InvestTalk Wealth Webinar. It's happening live, online, and free Thursday, November 9th from 1 to 2 p.m. Pacific Time. Go to investtalk.com and register now. Justin Klein is here and ready to take your calls live. InvestTalk, 888-99-CHART.
All right, my main focus point looks in the story set up by this headline, and that is lessons from the post-pandemic bull market. And I'm going to talk about the post-pandemic investment options that many people chose and investor behavior. And that's really what you need to learn, is to avoid a lot of the bad investment behavior and the animal spirits, which are strong when things are going well. The emotions are, we talk about all the time, avoiding emotions. And it's very difficult when your friend comes to you and said how they made so much money on this particular investment. I'm up 60% in 2 months. Right? FOMO, fear of missing out. Also known as greed, That's what I call it. The new word is FOMO. The old word is fear, or is greed, excuse me. Now that era of, we call it the coronavirus giddiness, it's past. Markets are down, asset prices are down from the peak in late 2021, or you call it January 2022. So let's reflect on it. Now, the first lesson is the Federal Reserve is powerful, but they're not all that smart. Right? They're very reactionary. Now, sometimes they react slow and sometimes they react fast. Now, in deflation, one thing you have to learn is in deflationary episodes, they tend to act fast. That's what the coronavirus lockdowns were. That's one of the most deflationary things you can do to an economy. Shut it all down. So what do? They put a bazooka out there, both federal government as well as the Fed. But they were slow to remove that accommodation. So I talk about all the time that so many people they have PTSD. The housing market is a perfect example. But what you have to realize is that so does government. And they put things in place to try to avoid that same scenario. And they will react in the near future to avoid a major deflationary bust like 2008 again. And that's what caused the reaction to COVID. So you have to really set your expectations for the way that the policymakers think and the way they are, what they're trying to avoid and what they're trying to accomplish. The next was, think of all the fads, the cryptocurrencies. That was Bitcoin price grew 11% in just a few months. Sorry, 11-fold, in just a few months. You had the meme stocks, Robinhood, SPACs, NFTs, and pretty much they're all gone, except for Robinhood, which is down by 90%. And then Bitcoin's still around, but most other cryptocurrencies are gone. So this is the lessons that you can take from this environment, that don't get caught up in the emotions. That's the main takeaway. All right, we're heading to a break. Give me a call now at 888-99-CHART.
One of the most rewarding things I do each weekday is host the InvestTalk podcast. I truly enjoy helping investors, and I know that every question counts and every answer I provide will be unbiased. You, the caller, get to chart the course for each InvestTalk podcast. Call with your questions anytime, day or night, 888-99-CHART.
Let's go to Noel in Napa looking at SIL, which is the Silver Miners ETF, the Global X Silver Miners. Do you own it or looking to buy it?
Oh, I own it, and I've had it for quite a while. Should I continue on with that, Justin?
Well, it all depends on your view on precious metals. Obviously, the miners are going to be much more volatile than the precious metals in general. And you've had a big reversal over the past few weeks in gold and silver. Silver's lagged just a bit, but it still has had a nice move. And I think this is the start of the next breakout in precious metals. So I think silver, SIL, should work its way higher. Although, as you've felt it's going to be more volatile, because it had those companies within there have operating leverage. So I would hold it at this point.
Okay. Thank you, Justin.
No problem. Thanks for the call. 888-99-CHART, 888-992-4278. Let's play two in a row right now.
Hey, Steve and Justin. It's Kevin calling from La Crescenta again. My question is about Texas Instruments. The symbol is TXN. They had earnings that didn't meet expectations and a fairly big drop last night and today. I have probably about 2% invested in there, and I'm wondering if you think this is a good time to add on to it at this price. All right. I appreciate your answer as always. Thank you.
All right. Texas Instruments is down pretty nicely from its high around $200 per share. Now we're at $144. Earnings came out. Revenue's down 14%. Earnings down 25%. But you're talking about $7.10 expected earnings this year. That's still well up from pre-pandemic levels, around $5.24. Very solid company with a very clean balance sheet. Next to no debt, net debt in its balance sheet. And I think that this is getting into major support. Now, the major support is around closer to 134. Now it's at 144. So you're about 7% away from there. Sometimes it doesn't get all the way there. So maybe you start a position, start adding to the position now. I wouldn't mind that. I just think this is a very good company approaching major support. The valuations are not too out of whack, 13.7 times enterprise value to EBITDA. The 5-year average is 16.4. So I think it's at reasonable valuations and getting close to that major support. So do you want to wait all the way to 134 potentially? But you're certainly in the zone where you want to start picking this up. So I like Texas Instruments. I know it's not the sexy name within the chip space, but it is a name that produces a lot of very basic chips, but basic chips go into everything in today's world, right? And the government is certainly supporting the chip sector here in the United States, and Texas Instruments is pretty much the original American chip manufacturer. So I like it closer to 134, but I also still like it here at 144. All right. Thanks for the call. Now let's touch a bit on, let's talk about the trends since June within the underlying market. And this is a very interesting study. And what it looked at was an equally weighted basket, so not market cap weighted like the S&P. And they looked at 50 companies within the S&P with the strongest balance sheets. Okay, and they rate them by what is called Altman Z-score. Now, you can go and look up the formula and everything, but basically it is a formula that was invented by a professor, I forgot where or whatever, but it's a very common way to get a good view of the strength of a balance sheet. Now, it's not perfect, it has its flaws, but it's a pretty good summation. And so we'll look at the top 50 Altman Z-scores within the S&P 500 and equal weights that. And then it looked at the 80 U.S. listed equities in the Russell 3000 with the highest floating rate debt as a percentage of total debt. And since June, that basket of those 80 that have a lot of rising rate debt, down 8.5% since the end of June. And the equal weighted S&P 500 with good balance sheets, it's only down 4.6. So still down, but just shows you the power of rising interest rates and how that impacts certain companies. So it's very important in this environment. Now, if you get a rally in bonds and a drop in rates, kind of got that a little bit today, you're going to see that somewhat reverse. But as I've been saying, this should be a message to you. If you're watching this market, you're studying this market, you should know that, okay, while near term, we may be at some sort of inflection point. I do think that. Long term, the trend is now in place. That the era of low interest rates and companies abusing those low interest rates by buying back shares and leveraging up their balance sheet, that is gone. That is no longer a winning formula. The winning formula is profits, cash flow, low debt. That is going back to that era of being smart with corporate finances. And if you find companies that can do that and stay that way, you'll be set to outperform. Now, the next Invest Talk, we'll look into the story set up by this question. Financial conditions are tightening. What does that mean? That's tomorrow, but for now, I'm Justin Klein, ready to take your calls at 888-99-CHART. If you've been wanting to learn a new language because you have an upcoming international trip, or you want to develop a stronger connection with your family heritage, or maybe picking up a second language could make you a more competitive job applicant, then Rosetta Stone is for you. Rosetta Stone is the world's most trusted language learning program. Rosetta Stone teaches through immersion instead of memorizing and drilling vocabulary words. You learn by matching audio from native speakers to visuals, reading stories, participating in dialogues, and other practical language skills. Rosetta Stone can fast-track your ability to communicate fluently in your choice of 25 languages. Rosetta Stone has a built-in, patented speech recognition engine called True Accent. So, as you practice speaking, you'll get feedback on how well you are pronouncing words. Rosetta Stone can be used on desktop or as an app, or you can download lessons for offline use. Rosetta Stone helps you tap into your brain's innate ability to learn language and gets you comfortable with communication in real life. In fact, with millions of users, Rosetta Stone has helped all types of language learners reach their goals. Now, for a very limited time, InvestTalk listeners can get Rosetta Stone's lifetime membership for 40% off. That's 40% off. And you get unlimited access to 25 language courses for the rest of your life. Redeem your 40% off at rosettastone.com/today.
James from Georgia, trying to reach you, Luke or Steve. I'm holding Google. Google is down almost 10% today. It's up 42.56% since I've been holding it. I've got a good chunk of this too. Should I be reducing my position? Curious what you think I should do going forward with Google. I'll listen for your answer on the show. Thank you.
I think you absolutely sell Google. This had ever since. And so this uptrend is now broken. So the technicals are now bearish near term. You made a lower high from the highs back in late 2021. And this is a cyclical name. Remember, Google is very reliant on ad sales. And Meta, in their conference call, talked about how early in the fourth quarter, they saw a noticeable dip in ad spending. And that's going to flow through to other companies within the digital advertising space. So, yeah, this is an absolute sell for me. And you just look at other names within the space, like Trade Desk, also in the digital advertising space, that's now below the 200-day moving average and in a clear downtrend. So, yeah, Google's the strongest probably within the space. But if you're talking about over the next 6 to 12 months, I definitely think Google is headed for a protracted downturn that could bring it all the way back down to where you saw it late last year, well below $100 per share and into the 80s. Now, at that level, maybe you start thinking about it again, but at this point, I would be selling it. All right, now when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for the courtesy by getting to their questions quickly. Barb in Brooklyn says, what are your thoughts on buying 10 or 30-year Treasury bonds now? Well, it depends on your time horizon. I've said, I think we're close to an inflection point on rates, and you've seen that really over the past 4 days. You had a big sell-off on Monday. I don't want to say sell-off, rally, I guess you could say, in bonds. A drop of the 10-year from right around 5% all the way to 4.7. It bounced back the next couple of days, and today you had another one. A drop from nearly 5% once again all the way down to, at the close today, 4.845%. So you're starting to see that momentum of rates going up reversing. And the odds are increasing that there will be a rate cut by second quarter next year. There's now a 37.5% chance that in the May meeting of next year, so that's right in the middle of that second quarter, that the Fed funds rate will be lower than it is today. It's pretty high. That's very high, especially if you consider 1 month ago, those odds we're at about 3%. Now we're at 37.5%. That's a big change. And so if you're talking about a trade only, yes. 10, 30 year, that's duration. That's a duration trade. Sure. But as a long-term hold, no. What I think is going to happen is you're going to go through a rate cutting cycle, but they're not going to go back to zero. They can't. They can't. Because inflation will rage too hard. And so they're going to mildly cut rates. You'll go through a rate cutting cycle and you'll bottom at a much higher level than we did before, right? An uptrend, make a higher low. You know, do we pull back from 5% on the 10-year to 3.5%? I think that's very possible in this cycle. But I don't think we're going back down to 1%. 2%. We're now in this longer term uptrend in rates due to inflation as well as our fiscal position. And so there's the secular cycle that I'm talking. That's a secular cycle, long-term trend. And then there's a cyclical cycle. For the cyclical cycle, yes, I think we're late cycle of this economic expansion. There will be a mild recession next year, which will precipitate a rate cutting cycle that will give a rally to 10-year bonds, 30-year bonds, etc. But inflation will not stay down. They will stay 3, 4, 5%. And then you'll get a turn back up. Now, is that a year? Is that 12 months from now? Is that 24 months from now? Is that 36 months from now? I'm not sure. We'll see. See how it goes. Hard to call it from here. But with everything, you always have to look at your time horizon. So short to medium term, yes. Long term, absolutely not. All right, let's talk a bit about, since we're on interest rates, talk about the financial drama that higher rates typically cause. And we're going to look back in history. Now, what's important to understand is that it's not about the nominal rate that a cycle takes you to. It's about the speed of that rate move. And obviously, we've had a huge move over the past couple of years. And what do? It triggered a regional banking crisis earlier this year. You also had a pension crisis in the UK. And both took governments to step in. Remember I talked about at the top of the show? They will step in. They will prevent a major deflationary bust. But let's look back in history, and there was actually a study It was published in May, and it looked at rate increases for 17 developed countries over 150 years. And it concluded that monetary policy rate hikes that were preceded by a series of cuts materially increase crisis risk. So doing big U-turns, right? Think of COVID crisis. Cut rates dramatically to the bone. Kept them there for a little bit and then ramped rates super high. It was a big U-turn because inflation was not transitory, because we're in this new regime. And so what this U-turn, U-shaped type monetary policy path does is increases banking crisis risk via credit and asset price cycles. So you get credit losses, liquidity crunches, and obviously highly leveraged companies, institutions of any kind, play a critical role. Now, going back to the 1980s, we had the S&L crisis. And this was really brought on by just actually bad government policy. We know the Fed ramped rates up in the late 70s and 80s to conquer inflation. And then what the federal government did was they set a cap on what the thrifts, the savings and loans, what they could pay for deposits. So clearly what happened? Deposit flight, just like everyone's doing now. I'm going to move my money elsewhere. Remember, nothing's new under the sun. There's always an analog in history. And S&L is a pretty good one for this. But a probably better one is Continental Illinois National Bank and Trust. This was 1984. It was the 7th largest U.S. bank in May of that year. And it suffered a global run on its deposits. Sound familiar? Silicon Valley Bank, anyone? What did they do back then? They were growing rapidly. Why? Because they were giving below market rates. And rates kept going up. Went from the 10-year Treasury earlier in the year, went from 10% to 13%. And so they were making below market loans. Those loans declined rapidly. They couldn't sell them because they were below market. And regulators seized the company, and it was actually the original too big to fail bank. Then you go back to Black Monday. That was also a time when interest rates moved up from 7.5% to 10% in a short period of time because the dollar had weakened against the West German mark. And that, combined with portfolio insurance and index arbitrage and program trading, which was in its infancy, created a 22% slide in the Dow. Now they turn those computer trading systems off if there's too much volatility. 94, you had doubling of interest rates in 12 months from 3% to 6%. The last hike was 75 basis points. And then you had the Orange County, California, here where I live. I remember I was in school back when that happened. Filed for bankruptcy. Pretty crazy. Then the dot-com bubble. June 99, rates went up. They had 6 rate hikes from June 99 to May 2000, and that popped, obviously, the 2000 bubble. And we all know what happened with the 07 recession. All right, now we get InvestTalk calls from around the world and all over America. This question came in earlier from DC at 888-99-CHART.
Great day, Justin and Steve. This is Rodney from Washington, D.C. Let me first lead off with I love the show. You guys keep up the great work. The 2 investments I'd like to get some insight on, have you guys take a look at, is VanEck Gold Miners ETF and the iShares Silver Trust ETF. Ticker symbols are GDX and SLV. That's gold, diamond, X-ray, and silver, laughing Victor. Appreciate it. Thanks for all the help and insight over the years, and look forward to hearing more from you guys.
Are looking to get exposure to precious metals. I guess a good time to do that. And you're talking about GDX, the gold miners, versus SLV, which is just the underlying silver exposure, silver prices. Now, the simple answer here is depends how aggressive you are. Silver is the safer way, or just SLV, in general, is safer than GDX. Why? Because GDX owns companies. Companies can have problems. Mines can shut down. They have balance sheets that they may have managed carefully or not. And then when prices of precious metals fall, they have operating leverage. So they tend to go down more than the actual price. But they also go up more than the actual price of the underlying metal because of that operating leverage. So GDX is going to be more risky. Silver is just the movement of that price, SLV. I think both are fine. I think you maybe have a little bit of both. But once again, it depends on your risk tolerance level. If you're aggressive, GDX. If you don't feel like you want to be that aggressive, then it'd be SLV. All right, I think we can squeeze one more question in now, so let's try.
I had a question on Schwab, the bank, ticker symbol SCHW. I just wanted to know your guys' thoughts where they're not mentioned as much as some of the other bigger banks out there. Thanks. Look forward to hearing, and take care. Bye.
All right, looking at Charles Schwab, and this is struggled because it has similar problems as the regional banks. But you could argue, and I kind of will argue, that this is now starting to become a better time. If you do get an inflection in those rates, right? If higher rates are a problem for the Schwabs of the world, then lower rates will be beneficial. And I will say, I'd much rather own Schwab than a regional bank. We use Schwab as our custodian. They're good. And guess what? They have a steady set of deposits from investors. Yeah, those investors might be buying treasuries and things like that, but there's money coming in. People sell their stock. What does that go into? That basically goes into Schwab Bank. And then they have to go and take that cash and invest it in somewhere else. And so there's always going to be a level of just cash, quote unquote, deposits that Schwab's holding. So I think over time, the fact that they did buy a lot of low yielding securities, their steady deposit base is going to allow them to manage through that. So if you want a duration play here, this is actually a pretty interesting one. So for the first time in a while, first time since this banking crisis, I'm going to give Schwab a modest thumbs up. And guess what? Now it's sitting near the lowest level since that crisis. But good day today on the back of lower rates of 4% today because rates did move. So giving it a modest thumbs up. All right, this is InvestTalk. I'm Justin Klein. We have one goal here each and every weekday, and that's help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART.
The stock market is volatile. It's constantly changing. So how are you positioned? Is your portfolio properly balanced, or are you taking unnecessary risks? You can get guidance anytime for free if you go to InvestTalk.com and take the brief Riskalyze quiz.
Hey, Steve and Justin. A little bit of a different question for you. Would just love your kind of personal opinion or philosophy on splurging on yourself. So we do a great job of kind of checking all the boxes. We max out our 401ks. We max out our Roth IRAs. We have our kids' college savings in place. We have a bridge account in place. So kind of check all the boxes and still have lucky enough to have some disposable income at the end. But I do personally have a hard time of getting out of the mentality of continuing to accumulate savings and things like that, and don't think we always spend enough on ourselves. So we just kind of love your philosophy or opinion on that and how you go about that, or recommend people to kind of change their mindset into actually spending some time. Thanks, and look forward to listening on the podcast.
I love this call. Love this question. Different. Talks more about personal finance, which is frankly just as important. Actually, sorry. It's more important than the investment side. I know the investment side's more interesting, but the personal finance, savings, and spending habits are far more important to achieving your goals. Now, it's great that you're maxing out your retirement accounts, you're saving consistently, and you have some more disposable income. Now, the first thing I would say is, have you built out a financial plan to know that, okay, if I save this amount consistently, I am going to have enough to retire by when I want to? Now, by the sounds of it, you probably will, right? You're maxing all that stuff out. It doesn't sound like you're a big spender, but maybe you want to retire when you're 45. Everyone's a little bit different. So first off, I would say you need to build that financial plan to know where you're headed and what your financial picture is likely to look like at retirement, whatever that age might be. Now, once you've done that and you say, okay, I'm on a good path, and based on a million scenarios, we do Monte Carlo simulations for our clients, that you will be on track, I actually think you should spend on yourself. You work hard, you've been disciplined, you're saving correctly, and life is about enjoying it, not just about counting your money. You want to do the things that make you happy, whether that is traveling, maybe that's just splurging on your children or maybe grandchildren or cousins or nieces and nephews, whatever that is. Maybe you have a hobby that you want to get into or do more of. I absolutely think you should do that. Now, I always say it's about the important aspect of spending is not wasting it. And a lot of people think, oh, well, I'm not getting anything for, say, a trip, for example, but I don't think it's a waste. Making good memories, deeper connections with family and friends, I think are very important to the human spirit. And I encourage you to do all of those things, the things that make you feel alive, make you feel fulfilled, are even more important than all of this. And when it comes to physical things, I actually say don't buy the cheapest. I've kind of learned that lesson. You pinch pennies, you go buy the cheaper version. What I always say is just buy stuff that you're going to use. That's the lesson I've come out with spending is you can go buy something that looks the cheapest and looks like a good deal. Let's just say that. Looks like a good deal. And that's what people oftentimes use to make their spending decisions. Is that a good deal? I don't think of it that way. I say, is this something that I need, that I will use regularly, that won't sit on the shelf? When you can do that, then